A cash flow forecast is a financial planning tool that provides an estimate of the expected cash inflows and outflows for a business or individual over a future period. It projects the expected movement of cash into and out of the organization, helping in anticipating cash needs, making informed financial decisions, and ensuring that there is sufficient liquidity to meet financial obligations. Key components of a cash flow forecast. Cash inflows. Operating revenues, cash received from the sale of goods or services. Investment income, cash generated from investments, such as dividends or interest income. Financing inflows, cash received from financing activities, including loans, equity investments, or other sources of capital. Cash outflows. Operating expenses, cash payments for day-to-day business operations, including salaries, utilities, and rent. Capital expenditures, cash payments for the acquisition or improvement of long-term assets, such as equipment or property. Debt repayment, cash used to repay loans and interest. Dividends, cash payments to shareholders as returns on their investments. Net cash flow. The net cash flow is calculated by subtracting total cash outflows from total cash inflows. A positive net cash flow indicates a surplus of cash, while a negative net cash flow suggests a cash shortfall. Importance of cash flow forecast in budgeting. Liquidity management. A cash flow forecast helps businesses assess their liquidity and plan for potential shortfalls. By identifying peak and low cash flow periods, organizations can proactively manage their cash reserves to ensure they have enough funds to cover operational needs. Budget planning. Cash flow forecasting is an integral part of the budgeting process. It allows businesses to align their projected cash inflows and outflows with their overall financial goals and budgetary constraints. Risk management. Identifying potential cash flow gaps in advance enables businesses to develop risk mitigation strategies. This may involve negotiating favorable payment terms with suppliers, securing additional financing, or implementing cost-cutting measures. Investment decisions. Cash flow forecasts assist in evaluating the financial feasibility of investment opportunities. Businesses can assess whether they have the necessary cash resources to fund new projects, expansions, or acquisitions without jeopardizing their financial stability. Debt management. For businesses with outstanding loans, a cash flow forecast helps in planning for debt repayment. It ensures that debt obligations are met on time and helps avoid potential default situations. Working capital management. Businesses can use cash flow forecasts to optimize their working capital. This involves managing the timing of accounts receivable collections, accounts payable payments, and inventory turnover to maintain a healthy cash position. Strategic decision-making. Cash flow forecasts are valuable tools for strategic decision-making. They provide insights into the financial health of the business and help management make informed decisions about resource allocation, cost control, and growth strategies. Crisis preparedness. Anticipating cash flow challenges allows businesses to develop contingency plans for unforeseen circumstances or economic downturns. Having a clear understanding of potential risks enables organizations to respond quickly and effectively. Steps to create a cash flow forecast. Identify sources of cash inflows. List all sources of cash inflows, including sales, investments, and financing activities. Estimate cash outflows. Identify and categorize all anticipated cash outflows, such as operating expenses, capital expenditures, debt repayments, and dividend payments. Determine timing of cash movements. Consider the timing of cash inflows and outflows. Some transactions may occur regularly, while others may be one-time events. Account for seasonal variations. If applicable, consider seasonal variations that may impact cash flows. Certain businesses may experience fluctuations in sales or expenses during specific times of the year. Update regularly. A cash flow forecast is a dynamic document that should be updated regularly to reflect changes in business conditions, market trends, or unexpected events. Compare forecast to actuals. Periodically compare the actual cash flows to the forecasted values. This allows businesses to assess the accuracy of their forecasts and make adjustments if needed. A well-prepared cash flow forecast is a valuable tool for financial planning and management. It provides a forward-looking perspective, allowing businesses to navigate financial challenges with greater confidence and make strategic decisions that support long-term sustainability and growth.